Every generation starts investing a little earlier than the last. Teen investing specifically has never taken off faster. Baby boomers didn't get into the market until they were 35 on average. Gen X started at 32. Millennials pushed it down to 25. And now a third of Gen Z started investing in university or early adulthood, double the rate of millennials at the same age. But here's what almost nobody talks about. You don't have to wait until you're 18. You don't even need money to begin. And the math behind starting as a teenager is so absurdly powerful that once you see it, you can't unsee it. Start with that math because it changes everything. If you invest just $50 a month in the S&P 500, which has averaged nearly 10.5% annual returns over the past 68 years, that $50 a month grows to over $1,067,000 in 50 years. Put that same $50 a month into a savings account earning 0.5% interest and you'll barely reach $34,000. Same money, same effort, completely different outcome. That's compound interest, and it's not magic, it's time. Time is the one advantage teenagers have that no adult can buy back. Here's another way to see it. If you start investing $200 a month at age 20 with a 10% annual return, you'll have roughly $736,000 by age 55. Wait until you're 30 to start the exact same thing, and you end up with $380,000. That 10-year delay costs you $356,000, not because you invested less, but because your money had less time to compound. Every year you wait costs you exponentially more than the one before it. So the question isn't whether teenagers should invest, it's how, especially when you're starting from nothing. The first step is learning before you spend a single dollar. Paper trading apps let you invest pretend money in real-time markets. You see what happens when stocks rise and fall, how companies respond to news, and how your decisions play out over weeks and months. You're building skill and intuition with zero risk. Two solid platforms to start with are the Investopedia Stock Simulator and Weeble's Paper Trading Mode, both free. This is where every teenager should start, and it costs absolutely nothing. The second step is earning money to invest. You need income, and the good news is there are more ways for teens to earn in 2026 than ever before. The traditional options still work: lifeguarding, babysitting, pet sitting, lawn care. But the online world has opened up entirely new paths. Teens are running resale shops, tutoring kids over Zoom, selling Notion templates, managing social media for local businesses, and even getting paid to test video games. Social media management alone can earn $50 to $200 per month per client. You don't need a lot, you just need something. Even $20 or $30 a month from a paycheck is enough to start building real wealth through compound interest. The third step is opening the right account, and this is where your parents come in. If you're under 18, you generally can't open a brokerage account on your own, but there are three main options worth knowing about. First, custodial accounts under UGMA or UTMA laws. A parent or guardian opens and manages the account on your behalf. All the assets legally belong to you, the minor, and once you reach the age of majority, which is 18 to 25 depending on your state, full ownership transfers to you. There are no income or contribution limits, no early withdrawal penalties, and no restrictions on how the funds are used as long as they benefit you. Two things to be aware of, though. First, if your family is planning for college, custodial accounts count as a student asset at 20% for FAFSA financial aid calculations, which can reduce your aid eligibility more than a parent-owned account would. Second, investment earnings above $2,700 in 2026 may be taxed at your parents' rate under what's called the kiddie tax, so it's worth talking to a tax advisor as the account grows. And if your parents are also considering a 529 plan for education savings, those work differently. Contributions go toward qualified education expenses and grow tax-free. But the money is restricted to education costs. UGMA and UTMA accounts are more flexible, while 529s are more tax efficient for the specific goal of paying for school. Second, and this one stands out, the Fidelity Youth Account. As of 2026, it's the only brokerage account that teens ages 13 to 17 can own independently. No subscription fees, no account fees, no minimums. The teen owns the account, makes the investment decisions, and the parent can monitor every transaction. You won't have access to risky instruments like cryptocurrency, options trading, margin, or short selling, and that's by design. It's built for learning and building real positions. Third, if you have earned income from any kind of work, a custodial Roth IRA might be the single most powerful account available to you. For 2026, the contribution limit is $7,500 or your total earned income, whichever is lower. So if you earned $4,500 this year, that's your maximum contribution. The money grows completely tax-free, and qualified withdrawals in retirement are also tax-free. Wealth manager Mike Schultz put it simply, many investment companies offer Roth IRA accounts with no minimum investment and no commission on trades. Now here's the key to making all of this work with little or no money: fractional shares. Instead of needing $1,000 to buy one share of a company, you can invest as little as $1 and own a fraction of that share. Fidelity, Schwab, Vanguard, and Robinhood all offer fractional share trading starting at $1 with zero commissions. You can even receive dividends proportional to your ownership. If a company pays a $1 dividend per share and you own half a share, you get 50 cents. It's real investing with real returns, just scaled to whatever you can afford right now. Once you're in, the strategy is straightforward: dollar cost averaging. You set up automatic monthly investments, even if it's just $25, and you put in the same amount every month, regardless of what the market is doing. Over time, this smooths out the ups and downs. You buy more shares when prices are low and fewer when they're high, which removes emotion from the equation entirely. That's exactly how disciplined investors build wealth over decades. When you're choosing what to invest in, broad index funds and exchange-traded funds are the most reliable starting point for beginners. Look beyond just the S&P 500, which tracks 500 large U.S. companies. Total stock market index funds give you exposure to thousands of companies across all sizes. Either way, pay attention to expense ratios, the annual fee the fund charges expressed as a percentage. The best index funds charge between 0.03 and 0.2% per year. That difference might sound tiny, but over decades of compounding, a high expense ratio can cost you tens of thousands of dollars in lost growth. A word of caution, though. One of the bigger trends right now is teenagers getting investment advice from financial influencers and social media. And many Generation Z investors are heavily drawn to cryptocurrency. Among Americans aged 18 to 27, 42% already own crypto, and 55% of Generation Z investors are primarily invested in it. Crypto can deliver massive returns, but it carries enormous risk and volatility. For a teenager just starting out, broad index funds and established exchange-traded funds are a far more reliable foundation. There's also a real psychological challenge here. Many Gen Zers report feeling overwhelmed by economic news and comparing their financial progress to others, especially people they see online. Some have lost trust in the financial system entirely, a trend researchers call financial nihilism. But the data consistently shows that starting early, even with tiny amounts, produces dramatically better outcomes than waiting. A few teenagers have already proven what's possible. Eric Feynman took $1,000 from his grandmother at age 12, bought Bitcoin when it was cheap, and owned over 400 Bitcoins by 18. Mosiah Bridges started sewing bow ties at 9 and eventually signed a 7-figure licensing deal with the NBA. Alina Morse developed sugar-free candy in the 4th grade, and her company, Zolly Candy, is now worth $6 million. These are exceptional stories, but they share one thing: none of these teenagers waited for permission to start building something. You don't need to become a millionaire by 18, you just need to start. Learn with paper trading on platforms like Investopedia or Webull. Earn income however you can. Open the right account with your parents' help. Buy fractional shares of solid investments for as little as $1. Set up automatic contributions. And then do the hardest part of all: be patient and let time do the heavy lifting. If you invest $100 each month at 9% annual interest, in 10 years you'll have over $18,000. In 20 years, over $61,000. In 30 years, over $163,000. All from $100 a month. That's not a fantasy. That's math. And the clock is already ticking.